All right, and now I want to spend just a few slides on stablecoins. Some of the data and some of the information that is here, I should say, it comes from the company called blockchain.com that provides some, consultancy insights on blockchain technology and watches the market. So, what is a stablecoin, or why is a stablecoin? Is really the better question. Now, cryptocurrencies that we've seen over the last few years are very unstable in terms of their prices. There's a lot of volatility, and so it's really not a very good, it's not really good money, right? Because when you have money, you want to know the good that you buy, that what you pay is really, doesn't change fundamentally all the time. Nobody likes that. It's but fiat currency, what fiat currency is a very good store of value and is a very good means of payment. But unfortunately, fiat currency is not available on the blockchain because no central bank has yet issued the digital currency. So why is that a downside? Well, you can't use it in smart contracts, and that makes it intrinsically difficult for the ecosystem to develop. So what's the solution? Well, the solution is a stable coin. It is backed essentially often by an asset. It is therefore pegged to a fiat currency and it will be available on the blockchain. So now the backing is important because it ensures confidence that the value is actually true. I just want to briefly mention that there could be other solutions other than these stable coins, which implicitly have also some form of backing. So, for instance, a central bank could issue a digital currency. A government can issue a debt contract as a token. So, in, for instance, $1 denomination. When the central bank creates money, essentially what it does, it actually creates, again, a debt contract so that, the left hand side and the balance sheet works. The government could also do this directly. They could go to a cryptocurrency exchange, issue these tokens, collect the money, and put them into an escrow. It's the same principle, right? Because they create a liability, the token, and they create an asset, which is the cash that they put in an account. And you can also have corporations do the same thing. So there's many entities could pencil issue these stable coins and do this credibly. So I want to briefly talk about taxonomy. So there's not all stablecoins, although this sounds very simple, it's actually the realities of this are a little bit more complex. So first of all, there's the standard collateral backed ones, but there's also something which is called an algorithmic stablecoin. I'll talk about that in a second. Now, when you have collateral backed, there could be traditional, right? So there could be gold backed, there could be fiat currency backed. So essentially, you have just some cash amount. You can also do them crypto backed, where you basically use, back it by Bitcoin and by Ether. This is a little more iffy, right? Because you have this underlying collateral essentially is very volatile, and you want to essentially use it for backing something that's less volatile. So in order to do this credibly, you really have to put a lot of money in there. Essentially, just options pricing would give you the right price that you want to use for that one. Now let's talk about the algorithmic ones. Now, the way algorithmic ones work is they basically try to have an algorithmic monetary policy, which comes from both seigniorage, so meaning that you basically sell the tokens in order to make money, and for fee-backed, so people who want to use these tokens have to pay fees, and that these fees essentially would indicate what would create the security that you need. I am deeply skeptical about all of these stable coins that are algorithmic. I have not seen any of those that actually convince me. That notwithstanding, they have retracted a lot of funding um, from outside entities, from venture capitalists and so on. So collateral backed ones have received funding of about $144 million over the last year. As the numbers are from November. Crypto-backed stable coins about $33 million, and now hold your breath. Algorithmic ones have received about $174 million in backing. It's an amazing amount for something which I think is fundamentally very difficult to solve, in particular because of this very simple idea of the impossible trinity in macroeconomics. Now, there's three things that that a economy worries about. There's the free flow of capital. So that's the ability for people, for investors to move money in and out of the economy, and which involves also, which basically is a necessary condition for trade. So if you want to do international trade, you need your money to flow back and forth. Um, Now, most people would like to have some form, or most countries would probably prefer a fixed exchange rate because that makes trade easier, it makes capital flows easier, makes investments in different countries easier. And over the years, many countries have tried to use pegged exchange rate, where they basically guaranteed a fixed exchange rate from one country to another. Was, for instance, in the 1990s, late 1990s, many of the Asian countries, Malaysia, Indonesia, and so on and so forth, they were all pegged against the US dollar. So that investors who want to make deals, or people, trading partners who wanted to trade with the firms in Southeast Asia, knew that for every local dollar of amount of local currency, they would get a fixed amount of US dollars. Now, finally, of course, every country would like to have sovereign monetary policy. So they will want to have the ability to change interest rates. They may want to have the ability to print money in bad times, and in good times to increase interest rate to ensure that the economy is not overheating. The problem here is that in any model of macroeconomics, you can have only two of these three. So if you want to have a fixed exchange rate and you want to have sovereign monetary policy, then you can't also restrict the free flow of capital. So what that means is essentially is that your money, when if you insist on a fixed exchange rate and you change the monetary, for instance, you lower interest rates, you may see capital outflows of your economy. If you want to have if you want to restrict capital flows and you want to have sovereign monetary policy, then it's very difficult for you to have a fixed exchange rate. You can't have one or the other. So this is essentially is an impossible trinity of macroeconomics. Pick one, you can't have all of them. So what does that mean? Well, if you want to have a stable coin, right, in which you have a fixed exchange rate, and you also want to determine what the monetary policy is, then you cannot do this with free capital flow because money will just leave your system.